evening. Great to see everybody. Great to be back in person. One of the things, this cartoon I realized was even more relevant was today. I was packing up and thrilled to see everybody in person for the first time in I guess 3 annual meetings, correct? And it's been we've been still dressing somewhat formally, but it's been a while since I've had to actually pack a tie and put all that stuff in. Anyway, I put it on when I got to Ottawa. I realized, you can probably see, this shirt doesn't fit anymore. Now, I swear that it's not me, it's the shirt that shrunk, but Blair tells me for sure it's me. I've expanded, so it's, and then I got to this meeting and Brian fixed my tie for me. Apparently it was over here, so I've been learning that there are some things to relearn as we get back from COVID, but looking forward to seeing lots more clients in person and seeing everybody from Tradex, hopefully from here forward and in person again. So, this page, if you remember nothing else tonight, hopefully this will be a good summary. We'll try to keep it interesting enough that there'll be other things to remember, but this will hopefully be a good summary. There are, before we touch on this, there are 3 things that I think are notable that we just want to touch on for you and in the synopsis, and that is, one, we've been thrilled to enjoy a 3-decade partnership with all of you and through the Tradex management team and board. It's hard to believe that 1992 is 3 decades ago. For me anyway, it feels like it wasn't that long ago, but 3 decades ago, and just thinking about how much water is under the bridge for the world and how many different crises we've been through and got to the other side of. So we really appreciate the confidence you've shown in all of us. The second thing is we're fortunate that I think we have another pretty good report card to present to you tonight on a 1-year basis, and then looking back over the last 10 years. So we'll hope that you're pleased that things are progressing in the right direction. And then third has been so often the case, even for the period I've been working with all of you. I think it's probably 13th or 14th time that I've been here with all of you. There's trouble in the world, there's trouble brewing, and we sure don't have the crystal ball. But I remember, there was a movie, some of you may remember, won a bunch of Academy Awards, Shakespeare in Love, and the gentleman that was running the theater is getting tackled for the money by the guys who had loaned him the money. And they say to him, how's this all going to work out? It looks to be such a shambles all the time. He says, I have no idea, but somehow it always does. And to some degree, that may be, when we look back over the last 30 years of the partnership, that may be one of the ways that we can look back at what's happened in the world. If you stuck with it, stuck with investing in any of the great solutions that Tradex has provided to you as unit holders and kept on pounding away, it's worked out well over time. And even though all of us as humans get so concerned in the interim. Anyway, we've got some key touchstones here in terms of how we invest, and I think all of you are quite familiar with it. It's a lot about stock picking primarily. We don't try to predict what the world's going to look like. We do try to run a lot of scenarios, recognizing that there's a range of outcomes for the world at any point in time, and then try to focus on the stocks that we think have the best reward to risk. We do blend that with a few other things to try to accentuate our performance, and some of those are highlighted there. Tactical mixing between Canadian stocks, global stocks, but even having, of course, the opportunity to have global stocks blended with Canadian in the portfolio was relatively unique subsequent to joining forces with you 30 years ago. And so some of those items are listed there. We'll talk about the outlook given the COVID shocks we've seen, the rates, the war clouds, not even war clouds, but the war that's certainly underway and unfortunately having shocking consequences. So we'll talk about what history as a guide might tell us about expectations in that kind of environment. Just touching for a moment with some levity on the last 30 years. It is quite amazing when you think back and you look at some of the characteristics here, and whether it's on the financial side, the Dow Jones Industrial Average was 3,300, and when we got to the end of March, it was nearly 35,000. Looking down at the bottom, George Bush Sr. unfortunately suffered the same fate as Winston Churchill, won the war and then was kicked out of office by Bill Clinton. Bill Clinton ended up being a wonderful president, at least in my books, as to what he accomplished in the United States, but quite an amazing outcome. And of course, a wonderful thing about 1992 that's easy to forget, because it feels like it wasn't that long ago, but is that the Blue Jays won the World Series. Now for Tradex, what's happened over the last 30 years has been, astounding when we think of what the world's gone through and all the scar tissue we'd all have from all those different recessions and crises that we've all been through. But the value of a unit holder's investment is up about 12 times over. And so that's been quite an astounding outcome. Of course, the markets are delivering the vast majority of that, and being disciplined and staying invested is making it all possible. And we're trying to do our part and get you some outperformance on top of that. I think you've just had a discussion with Mike in the City of London on ESG. Certainly a focus for everybody these days. It's an acronym that is got a tremendous runway in the past decade or so. You'll notice that the subheader, and it's probably a subheader I would have used last year as well, is that we've been at this for a couple of decades. Recently it's called ESG. For a long time it was called things like corporate governance, having some environmental sensibility, being engaged with your management teams to ensure they're doing the right things in their communities and for their employees, all those kinds of things. So for us, it's an acronym that now describes things we've always had embedded in our investment process. From the standpoint of giving you some sense of how we do it, of course, there's so much that goes into it, so I don't want to bore you with that, but there is scoring that's done on firms that want to participate, which is most major investment managers and most medium-sized investment managers around the world in the developed countries, and the UN carries that out. And we have been A+ graded since the outset. We know that there's a small portion of large managers that are A+ graded, and I think there would be a very small portion that would be A+ graded consistently since inception. So a lot of things we care about are captured here. There's more of them, but just gives you a sense that we care to be responsible investors. We thankfully carry a very influential role as the largest holder of assets in Canada and a major holder of assets globally. We take it really seriously, and fortunate to be part of the proxy committee that votes all our shares for a very long period of time. And I can tell you, having been a former equity analyst where I was disappointed with the way proxies were being voted and the kinds of movement that was being made in this area, as soon as I joined our firm almost 15 years ago, I was blown away by what a great job they were doing. So, and that's only advanced. So I think we can thankfully stand very tall and proud about what we're trying to accomplish there. With that, I want to just turn to Dylan, and he's going to give you an update on the performance side and our report card there.
Well, good evening, everyone. I want to echo Andy's comments. It's so good to be back in person. As a father with young children, it's great that I don't look over my shoulder where my 3-year-old's going to pull something out of my computer mess up my presentation. So it's really nice to be back to normal. I'm going to just touch on markets and give a capital markets update. This is looking over since December really 2020, but we're going to focus on the last year, so March over March. And I recognize you've already had some really good updates on the macro side already, so I'll try to keep my comments brief. But really what we've seen over the past 12 months is sort of a tale of two markets. 2021, the 2/3 of it that encompassed the past year, was an excellent year for markets, particularly on the developed market side, and particularly on equities. And it was really sort of a Goldilocks period, as we would say, because at the beginning of last year, of course, with the vaccines coming through, we did get a lot of hope that COVID was coming to an end. And what that did was that really lifted a lot of the sectors that had been left behind during that initial post-COVID rally over 2020. So you can think of sectors like energy, travel, commodities. They caught a bid. So that was great. We saw markets such as Canada benefiting from that. At the same time, remember, the rates were still really low. And the expectation through much of last year was that the central banks had everything under control, inflation was going to be transitory, and that we would end up in this perfect scenario where the rates won't climb too high to disrupt some of the higher flying sectors in the market that have done so well, such as technology and a lot of the consumer side. But they'll normalize enough that we'll get proper growth going forward, and such that we'll be able to keep a balance, if you will, and some of the achieved through the post-pandemic period, we'll be able to keep. As a result of that, the global equity markets ended the year up about 20%. The global developed markets, emerging markets, as you heard, were included in the story. And Canada led the way. So Canada, our market, of course, has a lot of exposure to energy, a lot of exposure to materials, as well as having increasingly more exposure to areas that are a bit more new but hadn't done well, such as technology and the like. So Canada, as a result, outperformed, and that's continued. Under the surface, however, though, towards the end of last year, we did see quite a lot of shifts coming through, particularly in the high growth areas of the market. So the stocks that did so well coming out of COVID, you think of Zoom Media, Roku, Teladoc, Amazon, so some of those super high flyers that came out, they started giving back quite a lot of their gains, as a lot of investors started to get the sense that maybe this inflation wasn't going to be transitory. Perhaps the Federal Reserve and the central banks around the world were going to have to act a bit more aggressively. And so if we fast forward now to the beginning of this year, that really did move ahead. We saw big reversals that you can see here towards, especially on the MSCI World. You can see that really cresting and then coming down quite sharply at the beginning of the year as investors started to get nervous that perhaps the good times were coming to an end, and that the central banks in particular were going to have to act quite a bit more aggressive than initially been anticipated. If we sort of take a look under the hood and take a look at sector composition and sort of what sectors were doing what year over year, it really does paint the story of this reversal of fortunes. You can see, with the exception of Canada now, most major markets have actually given up all their 2020 gains, or certainly most of them. Some certainly much more dramatic than others. And the sector change on the right-hand side sort of tells the story. So you can see here that energy, very strong performance last year. That's continued year to date this year, which is that lighter blue line. And at the other end of the spectrum, obviously, information technology sector that is much more exposed, if you will, to inflation, to rates, weighing us down. Now, this is just the TSX return, so this is just what's happening in the Canadian market. But you can see information technology down about 50% plus on our market. Now, a lot of that is one company, Shopify, but it wasn't alone in getting hit. Across the board, you can see just general weakness as well. Outside of those sectors, you'd expect to do pretty well in a rising rate environment, such as materials and staples to a lesser extent. More importantly, how are you doing? How is your fund doing? We continue to show really strong performance over both the 1 year and longer time periods. Most importantly, that's on an absolute and on a relative basis. So we want to obviously see that we're doing well, of course, on an absolute basis, but we want to make sure that we're keeping ahead and keeping on pace with our peers. You can see on the middle side, the global ranking, consistently number one over the longer term period, dipped back a little bit on the 1 year as the global component of this fund has slipped. Obviously, the global markets have, but the Canadian side has really kept up and done a lot of heavy lifting. So we're quite pleased with that result as well. And you can see at the bottom as well, the morning side percentile, still quite strong against the funds in the category. And we would hope that will continue, and we're quite pleased to see, particularly the longer term numbers, really holding up in this environment. So I'll stop there, I'll pass it back to you, and we'll walk through the next section.
Thank you, Dylan. So just give you a sense of the overall posture of the portfolio, just a high-level snapshot. We tend to just give you an illustration of the top 15 stocks each year, and one of the comments that we've made consistently is, whether we're, in terms of the top holdings, whether we're looking at companies that are familiar to household names in Canada that are listed in the Canadian stock market, or companies that are global based. Really, the portfolio is primarily, composed of companies that are really global industry leaders. And so when you look through this name, the set of names for example, in Canada, I think, lots of the names that are here, but down towards the bottom of the list, I think everybody's quite aware of the impact that Shopify is having. Nutrien may not be a name you're aware of. It used to be called Agrium. It's a major fertilizer producer. You can imagine with what's happened, unfortunately, in Ukraine, how important their product is. It's one of the largest fertilizer producers in the world, so it's very important to the whole agricultural space in North America and globally. And many of the rest of the names are household names. Now, one of the things that's a bit different this year is that in our top 15, there's 4 companies that are listed outside of Canada. In past years, as we've come to speak with you, we've had more companies in this top 15 that have been global companies. There's still a lot of global composition within the portfolio, but when you look at the bottom right-hand side, you'll see Canada, which is blue. So Team Blue is substantially more than half the portfolio now, and that is a purposeful tilt that we implemented in early 2021. It's fortunately been well timed. Prior to that, the portfolio had been moving towards being half global content, and moved up progressively over the past decade and change since we went through the credit crisis. We really had felt that global stocks offered much more earnings growth, attractiveness, better valuations, and much better opportunities. That ended up paying off well for us. Within this category that we competed, we could own up to 50% foreign content, and we went essentially to the max on that. And since early 2021, we really dialed back on that. Factors that were driving that was Canada had underperformed for so long. Valuations were much more attractive on a relative basis. We were also finally starting to see much better earnings traction, some potential for earnings actually to be the catalyst to start to recognize the Canadian stock market. And in addition to that, of course, we started to see some of the fundamentals finally turning for some key areas of the Canadian stock market that are important for driving the Canadian stock market to go from being a lagging market to being an outperforming market, which it has more recently. Some of those things you're quite aware of, things like the energy space, which have really been bombed out, and there was some transformation happening. We had underinvested a lot in energy. There's potential to see some much more tight supply-demand fundamentals drive this turnaround we've seen in energy subsequently. So some of those things in a variety of sectors attracted us back to Canada. So that's why you're seeing a little less composition. Rest assured, there's within every sector there is global composition within the portfolio, and really importantly, so in some of the most important sectors where Canada doesn't have the content we'd all like to have in terms of the opportunity set. So think of areas like information technology or healthcare. Give me a sense, I'll speak to the Canadian equity side of the portfolio, and then Dylan's going to come in and give you some context to the global side. As I mentioned, we're bottom up, so we're focused on picking stocks, the way I mentioned, from bottom up fundamentals. But just giving you a sense, there's a lot of investor angst. It doesn't matter if you're an investor or actually if you don't even invest. There's probably some angst about inflation, rising interest rates, recession potential. Certainly, these are things we're aware of when we're thinking about scenarios. It's not how we invest, so we don't go top down. We do go bottom up. But knowing there's that awareness of those concerns, one of the interesting things about the state of the outlook or the variety of scenarios we're looking at is Canada has a number of pieces of the puzzle to offer. So if we're concerned about inflation, real estate is a reasonable place historically and going forward where you can reprice based on inflation. So we've got a lot of exposure to real estate. The rails, and I think have these excellent toll roads we talked about before. They are in good position to pass through pricing. And also, as consumers are on one end concerned about the cost of products, as we all are. I'm sure we're all shopping at Dollarama, I know I do. And then Aritzia, which has become a North American success story in women's fashion, is at the other end of the spectrum where people just want that product so much. If there is, cost of goods increase, they can pass it through. So those are the kinds of things that you would see when you look deeper into the portfolio. So this lets you see a little bit of more of what's going on. Within the banks, won't surprise you, we think highly of some of the big Canadian banks, and I won't spend time there because people get usually lots on the banks. But the one thing just to be aware of with banks and life insurance companies is unusually they benefit more than other companies from interest rate increases. So they've been on the opposite end of that for a very long time, and that's pressured, has been a headwind on their earnings power. They're actually one of the few places that can provide some hedge in the portfolio against interest rates. And then on the recession side, nobody's recession proof. No company's recession proof. But certainly, for example, as we know, with some of the unusual dynamics that are there in the world and the cost to produce a barrel of oil in Canada, there'll be companies that are still extremely profitable unless we get a real surprising change in the supply-demand fundamentals for energy, for example. So a lot of different, opportunity sets that are unusually attractive right now within the Canadian stock market. Give me a sense, lots of interest usually from investors in the oil patch. Historically, actually, the interest has come from why do we own any? If you go back to the period, when we last were in person, and people would have been saying to us, not me in this room alone, but lots of people might have said, why would we have any? And geez, if we have any, we want it to be highly environmentally sensitive. Should we own any oil sands? And those are all valid concerns. And one of the things that we're just highlighting to you is that Canadian barrels of oil we think is getting more recognition, kind of like the Canadian banks in the credit crisis got recognition as being amongst the best. The Canadian oil producers are rapidly becoming amongst the best in terms of environmental friendliness. And so they're working very hard to get to net zero in their production of oil. Now, the fact is, when the barrel of oil is consumed after that, that's not good news for the environment, but unfortunately the economy still needs oil. So these are at least amongst the best producers of oil. They're very focused on emissions reductions. It's a very strong focus for them. And they have a very strong capability to operate. There's some stocks that are down a third. And so not every stock has gone up. So we're not showing you this to say, look at us, everything we picked was perfect. The interesting piece of the equation is, of course, it's not easy when you're a brand new company necessarily for your stock to go straight up, especially in the environment we're in. But the more important point to you is we're highly selective. We've had an exceptional period because of how strong the stock markets were of new issues. So companies coming public and companies selling more stock. These are the ones that we've participated in, and probably if there's a success here, so we're fortunate, through the end of March, there was a good return here. You can see that on the first line, so 21% average return. But most stocks, so more than 50% of IPOs in Canada were actually down over that period. So it's been a tough period for IPOs. The success really for us was really more dodging ones that would have cost us a lot of capital. But we do try to focus there and bring new opportunities into the portfolio. That is actually where Aritzia came from a number of years ago when it was a brand new IPO. With that, I want to turn to Dylan to speak about the global portfolio.
Thanks, Andrew. Here on part 17, we'll switch gears just a little bit and talk about the global section, the global equities, the global side of the portfolio. And we spoke earlier about why we have it and the benefit it is to blend global with Canada. And the reason is that when you get outside of Canada, you can really access some of the global leaders and global companies in sectors that we just don't have in our market. Maybe just a reminder of just what we look for, of course, when we're going out globally, we're looking to get these companies. And what we look for are companies that have what we call strong competitive dynamics. So these are companies that will have what we think are an innate advantage given their business model, given the markets that they serve, given the market share opportunities we think that they can take, and equally important given their management and the quality, we'll say, of their ESG. We think that's just so important to the long-term success of any business. You can see here on the left-hand side the top holdings in the portfolio. Some of these names, I think probably most of them you do recognize, of course, Microsoft, Alphabet, Google, Roche, Amazon, Blackstone. Certainly these are what you think of when you think of sector leaders or leaders in their respective fields. We do want to highlight that while this portfolio does tend to have a bit more of a growth orientation, so we're looking for companies that are growing and that are profitable, it is very diversified by sector. So you can see on the right-hand side, we're not trying to shoot the lights out just owning the highest, fastest growing technology companies, for example. We do think a lot about diversification, and we do want to have really broad-based exposure across all sectors. So it's not that we would, let's say, not prefer energy or materials, it's that if we're going into those areas, we only want to own the best energy company or the best materials company, because we want to hold these companies for the long term. So if there are structural issues in some of these sectors, and some of them certainly do have some structural concerns, we want to make sure that if we are going to go into them, that we're going to hold the one or the two companies in that area that we think over the next 5, 10, 15, 20 years are actually going to be around. And to that point, we do want to highlight just how long some of the holdings in the portfolio we've held them for. So you can see across the top that dotted line showing 5 years. And, a good chunk of the portfolio, certainly almost half of it now, we've held for at least 5 years. And you can see towards the end, well over a third we've held now for almost 10 years. So just to give you a sense of when we go into a position, we do go in with the intention that we're not coming in and out, we're not just trying to catch a wave. We really do want to buy these companies and hold them over the long term, because we think that's where you're going to appreciate the value, really is holding them over the long term. Because it's a concentrated portfolio as well, we are very careful to add and take out any names, because we really will have such strong conviction when we come in. The one thing I'll point out is this portfolio does tend to have very low turnover as a result of this long-term mindset. But in recent quarters, we have actually been fairly more active than usual. This is a bottom-up process, so we are looking at companies. We're not trying to make macro calls, given where we think the market's going to go in the next few months. But that being said, when we do sense a bit of a shift in the macro environment, we will act, we will make some tweaks. And that's something that we're certainly seeing now, given the inflation background, and given probably more broadly what we're seeing on both in terms of supply chains and the broader move at the moment towards the deglobalization. And as a result, we've added companies we think that will stand to benefit from those macro forces. Some of them you'll probably recognize. Pepsi is one that we've added. So this is, of course, a large consumer staple company. CSX is a domestic rail network and rail provider in the U.S. Equinor is one I'll talk a bit more in detail, because this is an energy company. And for us, finding really good energy companies, traditional energy companies, so traditional oil and gas companies, has been very, very hard. Particularly when you get outside of Canada, as Nancy mentioned, these companies tend not to be the highest quality, or certainly we don't think are going to be around necessarily forever. Equinor, however, does stand out for us. So this is a Norwegian company. It's the second largest gas producer in Europe, and the second largest gas supplier in Europe. Gas, of course, natural gas, liquefied natural gas is becoming quite in focus now, given what we're seeing in Europe and in Russia. So we really like the business dynamics of this company. We think that as Europe tries to decouple from Russia, they're going to look towards sort of the internally where they can source more reliable, more friendly sources of gas, and this company absolutely fits the bill. But longer term, so we're thinking 5, 10, 15 years out, this company is above all really transforming itself into a real player in renewables and the low carbon solution business. And you can see just on the lower right-hand side just how much capital they're spending to really become a large player in that. And that's something that attracts us as well. So we're thinking in the near term, we think they're going to benefit from, certainly what's happening in Europe and around the world, for more demand for more safe and reliable sources of energy. But longer term, we know that the shift will be towards renewables, and companies such as this one stand to benefit absolutely from that structural change. Moving us to a holder that's a lot more long-standing for us. We don't talk about the cosmetics business much. It doesn't really sound flashy as tech or doing with energy anymore, but it's actually a very, very good business. And Estee Lauder, to us, is really the best in class. This is a company we've held for quite a long time. One of the reasons we like the cosmetics business as a whole is that the margins are really good. And the brand loyalty, the brand stickiness is excellent. So people, when they tend to find a cosmetic product they like, they tend to stick with it for life. And as a result, you really get really stable revenues and really consistent brand loyalty. The one thing that keeps us really constructive on Estee Lauder going forward, and you can see on the lower right-hand side, is they've become really a global brand. So if you think back to 2016, you can see in the blue bars how much of their revenue sources just were dominated by Europe, really, and the Americas. But over time, fast forward just 5 years, 2021, you can see that they've become a real player in Asia. And particularly certain markets like in China and India, they've done quite well and really established themselves. So one of the things we like about that is, of course, that provides them a lot more diversification in their revenue streams, which we think over time will allow them to become a much more stable and sustainable business, and certainly it's giving them a lot of growth opportunities, particularly in emerging markets where we're seeing demand for things like cosmetics and personal care really, really starting to surge. The last company we'll talk about is Taiwan Semiconductor. I know that we've talked about it in the past. This really is the premier chip producer for the world. Everything nowadays is going digital, as we know from our daily lives. And I think if you look at the revenue breakdown on the lower right-hand side, it sort of tells the picture. If you think about 10 years ago, the chip demand, particularly for the high-end chip demand, really coming only from really one source, maybe two. So computing, of course, smartphones were just coming up, and to a smaller extent, consumer electronics. But what we're seeing is the demand for chip growth is broadening out quite considerably. So if you look at any kind of capital good nowadays, whether that's cars, whether that's microwaves, fridges, they all come with massive screens, and the demand for computing power required for these products going forward continues to grow. And this is an industry, particularly on the high-end side of the chip development business, that has incredibly high barriers to entry. So it's not something that companies can easily enter. Governments are trying, the U.S. in particular, China as well, but the barriers to entry into the production of chips is just so costly that it really is prohibitive. So this is a company that, despite having absolutely stellar returns over the last few years, we still remain very constructive on going forward and think that over the long term this will likely be and remain one of our core positions. With that, I'll maybe turn back to Andy to talk about inflation.
Okay, thank you. So one of the things we've been asked to comment on is the outlook on markets. And of course, all we can probably all presume is that there's growing risk of recession, there's growing risk inflation is here to stay, and those are possibilities. We don't know perfectly what the probability is, but it seems like growing probability of those risks and many others. One of the things that we're seeing is sort of, when we think about this, is what are the causes of this spike in inflation? And I think others have commented on it because it affects all your portfolios. So maybe if you just look at all of these words, you can get a pretty good picture. But what it boils down to is there was a shift for all of us in the midst of the COVID crisis, and going exposure is to areas like real estate and development. So with that, we want to thank you very much, and for the long-standing partnership, and for your attention and interest in seeing us tonight. So thank you. Any questions are welcome. Subject to the chair, of course.
Go ahead. I'm curious, following your presentation, with the war in Ukraine, all NATO nations and allies have been encouraged to increase their defense spending. I didn't notice in your portfolio any weighting in the defense sector or associated areas like artificial intelligence. Do you have a plan to address this, or is this outside the scope?
No, that's an excellent question. Repeat the question. So the question is, have we made a decision to invest in defense companies within the portfolio based on the recent events? And what about artificial intelligence, since it plays into defense? So the short answer, to your question is no. We don't have any direct defense holdings. So direct defense holdings might include thinking about a company like Raytheon, might include owning a company like Boeing. So we don't have any direct holdings. We haven't made a change there. It's actually, it's an excellent question and a really fair point. One of the things that we would see in the portfolio is that we're going to benefit in a number of different ways. So defense spending or artificial intelligence, we've got some great contributors to that within the portfolio. So indirect contributors and direct contributors. So our chip makers are direct contributors into the defense business. There are also a number of companies that are participants in artificial intelligence, to your point, that will be beneficiaries there. And a number of them have outstanding contracts with the defense companies, but we don't have anything direct. One of the reasons for that is really from an ESG standpoint, where we are big believers in ESG, so we don't really typically want to own companies that are producing weapons and producing items that are causing destruction, but we will secondarily benefit in a number of other ways if there's growth in the areas we But to your point, by the way, I mean, that has been a good spot to be this year. So
Just-
energy and
just-
defense stocks has been a great spot to
Just
be.
a quick follow-up, like the Stinger missiles that we're hearing a lot about, and the latest reports.
The
US
javelins,
Yeah, but the Stingers in particular, they don't have a target date as to when they can catch up, just to meet the US demands.
Demand.
Based on everything that they sent from Ukraine.
Yeah.
So it's a huge mark.
You're absolutely right. And if somebody did want to invest on that theme, you know, we don't have that direct exposure, but should you want that direct exposure, you know, there'd be an ETF you could purchase with the advice of your friends at Tradex if you wanted to go direct. I don't think I'm making a false advertisement there. Is that correct, Blair? You can own ETFs, correct? Yeah. So that opportunity set exists. The good news is we got a full service capability.
Given the trend of rates increasing in the foreseeable future, what adjustments have you made to the different sectors and sector rotation and the portfolio in terms of the micro, different companies that you invest in?
Sure.
Can you tell us a little bit about this, please?
Sure. Maybe I'll start with the global portfolio. So you can actually see, in a sense, so this is giving you a sense of ownership period. And as you know, so if you go to the far right hand side, you're going to see some of the latest additions to the portfolio. That's going to help answer your question. So because of some of the factors that are affecting the environment right now, where we have these really tight commodity supply-demand balances, you can see, for example, the global portfolio, Equinor, which Dylan spoke about, has been positioned in the portfolio. First Quantum, which is a major copper player, actually a Canadian company, is also in the portfolio. There's very tight supply demand fundamentals in copper, and as many of you probably know, copper is in huge demand in areas like electrification. So everything you see that's electrifying needs a lot of copper. And so First Quantum is in the portfolio. One of the other areas that we were talking about is rail and the ability to pass through prices. So you can see CSX is in the portfolio. That's a major railway in the United States. On the view that other areas where we can see good pass-through pricing, PepsiCo has been put in the portfolio. So it's we could have